That's right, folks. I think I got the microphone figured out, and I hope you're excited. I know I'm excited. That was quite the pain. We did some troubleshooting. We're back, and we're going to be talking about none other than Fubo TV today. Why are we talking about Fubo TV? Well, this is a stock that has been nothing but plummeted. We're talking about a 80% downward movement, and on top of that, we see yet another 15% move in after hours after this reported earnings. Wild, wild stuff. 52-week high at $43. Now sitting at $6.45 at its 52-week low. It's crazy, crazy to see that. So let's go ahead and take a look at the stock, see what's going on. Why are we plummeting, okay? What's this additional 15% about? You saw an initial positive reaction at the launch of these earnings and then quickly turned negative as investors kind of wait on a lot of things. And obviously we have a lot of negative things going on in the market too. Not necessarily something that affects them, but let's take a look at Fubo TV, which is obviously a smaller company. So non-GAAP EPS line are negative 57 cents, missed by 1 cent. Again, I'd like to see what that looks like in terms of a GAAP net income perspective or really net loss. Obviously this company loses money. It's still in its infancy. It's just kind of how it happens. It's how these tech darlings do, and guess what? You're not really successful if you're a tech darling in this current stock market. It's not how it works. You talk about a couple of years back, you were launching to the moon, and Fubo did launch to the moon, obviously, as one thing you can tell from the 5-year chart. Again, we saw several times in which we launched the moon. Early 2021, another moon launching. Really just off of hype that they were another streaming company, but look, it ain't all that good. But this revenue line looks pretty solid. $229 million, up 118%, beats by 16.4 million. That's nice stuff. They beat on a revenue perspective and by a good margin when you consider what they're looking at. Still a small company, all things considered, but this does put them over $1 billion for the entire year. Now we're going to look at the Presentación de PowerPoint, as it says. Curious because I believe this was a United States company, but I suppose it isn't if we got Spanish there, but it's okay. So what do we have? The first slide they show you obviously is subscriber numbers because that's what matters with these companies. And they were able to put up a decent line here, 1.13 million subscribers now, first time over a million, which is positive, and they added 185,000. Now you want to keep that into consideration because you look where they were even in Q4 of 2020 at only 548,000. In a full year, they did double subscriber count. We'll give them that. But when you look at the grand scheme of things, they only added 500,000 subscribers in a year. And I'm not going to compare. Look, I think it's unfair to compare them to some of the bigger companies out there. But when you look at companies like Disney, if you consider Disney Plus, started out at 26.5 million, and since then has been adding millions and millions since then, right? And it's a more well-known company. I get it. Netflix is the same exact story. They don't have really any quarters in which they add this few subscribers. And I think that's where the hang-up comes from when you talk about investors right now. This is not the kind of market where companies that are, I mean, I hate to say they're fake. They're not necessarily fake. They're just not the real deal yet, right? These are companies in their infancy. And if I'm being honest with you, I don't know. They don't know the future of Fubo TV. There's so many streaming companies that no one knows which one's going to survive. Odds are some might get bought out. A vast majority might, and some might just completely fold. So that's kind of where you're seeing the issue. Advertising revenue saw a 98% increase. Obviously fantastic for them. 25.9 million. Not the majority of the revenue, seeing as most of it comes from subscriptions. Average revenue per user. This one I find a little concerning if you're honestly asking me. It declined this year, right? Declined around 4%. Nothing crazy, but that's not the kind of line you want to see starting off. This is how you get towards a trend of profitability. It's the only way you do as one of these types streaming companies because you're paying for streaming content. The only way you can afford that is to make each subscriber more valuable. The more valuable that they are, obviously, the more revenue you're getting from them, and therefore the more profit you'd be getting from them in essence. So, not a line I like to see. I don't. I mean, I get they have to show it, but it's not. That's advertising average revenue per user, of course. Just would like to see maybe we see some increases there, but that's okay. There's other things we can look at. Overall, there we go. Overall, average revenue per user did see an increase. Okay, so now we're getting to the sign of positivity, around an 8%, and that's very nice when you're talking about where it's at right now. That's a fantastic one for them. Curious what the advertising line's from. I guess because the increase, vast increase of subscribers likely led to, less overall revenue. Because some might not be, paying for the full deal with ads, or I guess they might be paying for no ads. I suppose that's potential there. So, very nice stuff there. Expenses as a percentage, you do like to see this because expenses did seem to increase, but still 147% expenses to revenue, decreased quite a bit from Q4 2020. So there's definitely a trend that you can see in the positive. I suppose so, because again, if you look over 2019, you saw actually less than you saw in Q4 of 2020. So it's still overall a positive trend over the last year, I guess you could say. But there's good things to look at there. Good things to look at, but still, there's some concerns. I mean, when you look at solely this line here of player-related expenses, that alone is already 93.5 expenses to revenue. I mean, good golly, they're not making profit almost off of just one segment. Then you include all these other ones, 20 here, 14 there, 6 there. Those aren't going away, right? Sales and marketing is not going away. Technology and development is not going away. General administrative not going away. Depreciation and amortization, like that one's, could go away. But subscriber-related expenses, again, this kind of stuff won't go away. So they're really going to need to hone down this player-related expenses line if they want to have a chance of profitability in the future. And I think they can get there, but it's not necessarily a clear-cut trend, as you can see here. Last year was a terrible, terrible year for them profit-wise. It's still, the stock decided to perform super well. It's hard to say. But then since then, I think investors have kind of seen what's going on here. But they were able to cut it around 48% from the year prior. So there's positivity to look at there. But still about double what it was in Q4 of 2019. And I understand expanding the business can lead to higher expenses in the short term, potentially even long term, but we'll see. What I don't like is this adjusted Ebitda line, which has increased significantly. Quite significantly if you look at it. 82.6 million, obviously, compared to 43 of last year, in which the net loss line was so much worse. Not sure why this adjusted line is so much worse than it was, but it's not a good look for him, okay? Not a good look. Adjusted EPS build here, as they say. What's going positive for it? GAAP EPS here of 76 cents negative. Not good. Again, to lose $112 million while making 220. I mean, we're talking about 50% of your revenue is complete loss. So it's kind of crazy to look at that. But there were some positives here from stock-based compensations, amortization of intangibles, and amortization of debt discount, which led to a better adjusted EPS line, but still not what I necessarily care about. So for the full year, North America streaming revenue came in at right around 1 billion, right? Subscribers increased by 500,000 since Q1. So that's not crazy over 3 quarters, but it's not terrible. And the rest of the world, not much movement there, nothing really crazy. The revenue line increased by quite a good margin though, but subscriber count not very much. So I guess that's positive to see there. This is the world's smallest chart, in case you were curious. They better not do that for the balance sheet, which isn't located on here, obviously, because why would it be? Look, we don't need a balance sheet on these guys, apparently. My bad. So don't worry, we can fix this, okay? We can fix this. Can we fix this? I don't know. I don't know if we can fix this, but we're going to find it, guys. Look, that's the thing about us. We're really, really all about this life. I mean, you'd hope it's going to be on the press release, but I don't know. You never know with some of these companies. They may not be on there. Oh, heck no, it isn't. So, heck no, it isn't. Shareholder letter? Oh, baby. You know it's on the shareholder letter. They can't hide a balance sheet from me. I'm going to scrutinize this balance sheet, folks, just because you're hiding your balance sheet from me. You can't hide your balance sheet from me, okay? That's one thing I won't allow in this house. I won't allow it. That's right, I found it, folks. I found it. Come at me again with that crap. Full year comparison. So I like full year comparisons. I really do. You know that. What the heck is a cash reserve for users line? That's the weirdest balance sheet line I've ever seen. I'm just going to forget that exists. 428 million compared to 156 million of a year ago. Obviously, massive increase in the cash position here. And other accounts receivable, prepaid, current assets. So there's positive news there. From a total assets in general line, 1.3 billion compared to 859. Quite a bit of assets, all things considered, when you look at this company. So there's positivity there. Increase in this goodwill line, which again isn't necessarily crazy, but property equipment up. So there's positive things, and other non-current assets. Would like to know obviously what that means, but not too bad. From a liability standpoint, we saw some increase, right? You can't fit your freaking balance sheet on one page, guys. Investor relations team, you gotta get it together, folks. You can't fit the balance sheet on one page. I mean, good grief, what are you doing? 337 million compared to 227, so $110 million increase over there. They did raise capital, as you can see from this convertible notes line. Not good, obviously, when we're adding up all these expenses, but total liability sitting at 698 compared to 236. Not necessarily the greatest line. There is shareholder equity here, right? This is not a company running a deficit, and it did increase slightly over the last year, 670 compared to 622. Not terrible. I mean, the most line here of the liability is really going to come from these convertible senior notes, which obviously expire thoroughly throughout the next couple of years. So nothing crazy there. So yeah, I mean that's kind of Fubo TV. Again, it's trading at $1 billion market cap, so it is technically dirt cheap when you look at a price to sales standpoint compared to where a lot of these stocks have been trading. Do I like Fubo TV at these levels? I still don't. Let's just be honest. And again, it comes to my point that I made prior. I don't think Fubo TV is one of those that's going to necessarily survive. Look, I don't think it's a big enough company, and I think the big ones are going to be the ones surviving. Hulu Live is going to eat up a lot of Fubo TV, and I think Disney could be an acquisition standpoint potentially. There's just too many streaming services right now, and unfortunately not all of them are going to survive. There's not 8 million cable companies that survived. I mean, it's not how it worked. That's not how it worked back then. There were 4 big ones, and that's kind of how it happened. And there could be room for some small players, but not necessarily those that are going to, bring it to the moon. So just keep that into consideration when you think about Fubo. That's what I got for you. The market's going to be uncertain anyways for a while, regardless of what Fubo does. So I hope you have a great day.